Well, good afternoon. Happy Friday, December 27th. Mark Milam here. Last update for 2024. Boy, not exactly where we thought we would finish up 2024 in terms of the world of interest rates. We're a good half point, maybe in some circumstances, a quarter point higher with mortgage rates than we were this time last year. So as we approach the end of 2023, mortgage rates were in a lot better territory than we find them today. And that's a bit ironic, because inflation has largely been defeated. Of course, we're still not quite to the Fed's target rate of 2%, but we're certainly well on our way and have made substantial progress this past year. The Fed has been cutting the Fed funds rate already 100 basis points worth of Fed rate cuts since September the 18th, but that has just simply not translated into long-term yields. Now, mortgages track with the 10-year Treasury. If you're starting looking for a publicly available data on what's happening with mortgage rates, you need only look at the 10-year Treasury yield. And I'm going to flip the screen around here and show you something pretty fascinating about the 10-year Treasury yield. So this is these are mortgage-backed securities, but we can switch up here at the top. We can switch this to the 10-year Treasury and go back and take a quick look here. So right here on September the 16th, right before the Fed began cutting, the 10-year Treasury was trading around 3.62 for the yield, right? 3.62 was the actual rate. And then as the Fed cut and continued to cut, the 10-year Treasury just simply went up, 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 and up. We got a little swoon here in late November, early December, but finishing out, look right there at 4.62. So in other words, we have seen 100 basis point of long-term yields going up while simultaneously having 100 basis point of short-term rates, the Fed funds rate, going down over a period of, what is this, a little bit more than 3 months. Let's flip the screen back around here and I'll show you one other image. This right here, this 100 basis points up with long-term treasuries or 10-year yield, and 100 basis points down with the Fed funds rate. This right here has never happened before in the history of the United States. We have never seen that kind of divergence between the Fed funds rate at the beginning of a cutting cycle and 10-year yields simultaneously going up. So it's fascinating to see what's happened here. Not the news that we want, but certainly merits watching as the calendar ticks from 2024 over into 2025. Hopefully we'll get a sharp rebound as we move into January and we can start to see some moderation with those long-term yields. It's going to take good information on inflation. We need inflation to continue to moderate, but also perhaps some softness in the labor market. We need to see, strange as it may sound, initial jobless claims to rise a bit, non-farm payrolls to be suppressed a little bit more, to see some softness in there that labor is not going to spark a rebound or a resurgence of inflation in early 2025. That will be the tail of the tape. It will be interesting to see how that plays out. If I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam at highlandmtg.com.